welcome to the lecture on financial leverage and total leverage. So, in the last lecture we discussed about the operating leverage, and we know that the leverage is categorized into three parts. One is operating leverage, then we have financial leverage, and then total leverage. So, let us discuss about the financial leverage and the total leverage. Now, financial leverage is the responsiveness of the change in a firm's earnings per share, that is EPS, to the change in operating income or profit or earnings before interest and taxes. So, basically this is something like when you talk about the financial leverage, then you have to have the operating income changes, and then also the earning per share, and how they reflect change in one, how that is reflected into the change of other, like once you have the operating income or profit or earning before interest and taxes. So, how that change reflects to the earnings per share. So, that is basically represented by the financial leverage. So, it expresses the potential use of fixed financial charges to magnify the effect of changes in operating income on earnings per share. That is what we discussed, that it will be talking about the magnify the effect of changes in operating income on the earnings per share. Now, the fixed financial charges here are like interest on debt and dividends for preferred stock. These are the fixed financial charges, and basically they affect many a times when you have to find the net income, or we have to find so there are many debts or dividends which has to be paid, and there are also taxes which are to be deducted. So, all that is to be taken into account, and these are the liabilities which are at the lower part of the balance sheet, and they are taken into care while finding this financial leverage. So, ultimately for this change in the operating income, what is ultimately its effect on the earning per share, that is how this financial leverage will be talking about. So, it is also called the other people's money or trading on equity or debt financing. So, that is also another name. Now, in these cases what happens, that many a times it has been found, it is a truth that the returns on debt investment are higher than the returns on equity investment. So, this is is found to be true. Then debt capital is most likely to be readily available. So, that is also there, because once you have taken debt, that is more readily available for the use by the company, and because many a times you have to, if you are using the the other person's money or so, if you are using the money of in other form, maybe sometimes, then you may have other obligations to be performed. Then using debt capital usually does not affect the voting situation in a firm. So, when you have you use these debt capital, then as it indicates that the voting situation in the firm is not affected. Many a times in some situations you may have to give the voting rights, or you have to ask how to use certain sum. So, that is basically not affected. If a firm has a high fixed cost of financing, it would be considered heavy on financial leverage, and would probably enjoy high returns on investment, but would in turn face financial risks, potential financial risks. So, that is also the truth, that if you have the high fixed cost of financing, in that case there may be higher value of financial leverage. So, but then there are certainly how much you are taking, so how much is the debt or so. So, in those cases there are certainly some risk. Now, similar to the operating leverage as we have discussed, there is also a term known as the degree of financial leverage, DFL. So, in that case you had the operating leverage, and in this case, so we discussed about DOL, degree of operating leverage, and in this case we get the degree of financial leverage, and the degree of financial leverage is basically the responsiveness of the change in earnings per share to relative to the change in operating income. So, basically when we talk about the degree of the financial leverage DFL. So, as the definition indicates, it will be percentage change in the, so it will be denoted by DFL, and it will be percentage change in the EPS. So, that is your earning per share, and this is relative to the percentage change in your operating income. So, so the OI is the operating income, and your EPS is earning per share. Now, what happens that you will have two values, suppose EPS 1 and EPS 2. So, basically when EPS 1 will change to EPS 2, in that case in the second year if you have the value of EPS as EPS 2, and then you have the EPS 1 value in the first year. So, change and divided by EPS 1, because change is from EPS 1, and this will be divided by OY 2 minus OY 1 divided by OY 1. So, this is your operating income for the first and second year. So, based on that you can calculate these DFL values. Now, when we talk about the earning per share values, so EPS, so when we talk about this earning per share, it will be referring to the net earnings basically, and that net earning which is basically distributed to common stockholders. So, this is net earning that is distributed to common stockholders. So, what we calculate this EPS will be, so EPS will be equal to net income and the earning per share. So, you have to divide it with the number of shares in common stock. So, that is of common stock, because we will discuss later that there are stocks also of two types, common stock and preferred stock. So, this common stock we are talking about here. So, this will be your net income divided by number of shares of common stock. Now, in this case once you have the preferred stock, if you have suppose preferred stock, then they are to be paid first, their dividends is to be paid first, we know that. So, that we will even study once we study about the stocks. So, in case of preferred stocks, what we do is that their dividends are to be deducted first, their dividends are to be deducted from net income. So, in that case what you will do is you will find EPS as net income minus the dividend which you are paying on the preferred stock. So, this will be preferred stock dividends and that will be divided by same thing like number of shares of common stock. So, that way we calculate these EPS, and once you calculate EPS, then operating income is anyway calculated based on the data, and you can calculate the degree of financial leverage, and the value of financial leverage once you get, that will tell. So, suppose you get financial degree of financial leverage as 1.5, it means if the change in operating income is 1%, in that case the change in the earning per share will be 1.5%. So, that is how we calculate these degree of financial leverage, and we can also see by looking at an example. Suppose there are certain data which is given, and suppose you have some item is given, and here under that you have year 1 and year 2 values are given, and suppose you have gross income in the first year. So, in the terms of rupees is 30,250 and this is 32,900 suppose, and then operating expenses, let us say this becomes 10,100 and here it is 10,940, and interest what is deducted is basically 766 and this is 870, and income taxes suppose which is paid is 3,400 and 3,490, and then number of shares suppose is 30,000 here and 30,000 here also. So, suppose for this data you have to find the degree of financial leverage for the company. So, how you will proceed for finding the degree of financial leverage. So, to find degree of financial leverage for data provided. Now, this is the data provided, and for that for the company you have to find the degree of financial leverage. So, you have to find the change in the operating income, and you have to find the change in earnings per share, and then you have to get the ratio of earning per share by operating income changes. So, you can calculate these operating income for year 1. So, that will be operating income will be for year 1. So, it will be basically gross income minus operating expenses. So, you have gross income as 30,250 and operating expenses is 10,100. So, it is coming as 20,150 rupees. Similarly, if you operating expense for year 2, operating income in year 2. So, here also you will be having the subtraction of operating expenses in the second year minus the net income gross income in the second year. So, gross income in the second year is 32,900 and in this case it is 10,940. So, it will be 21,960. So, this is your operating income in year 1 and year 2. Now, we have to calculate the earning per share. Now, earning per share, for that what we do is we need to calculate the net income. So, net income if you see, so earning per share we know that it will be net income minus and divided by the number of shares. So, net income will be your operating income whatever you have got, and then you have the interest and income taxes which are paid. So, that is to be subtracted. So, you will have the net income, you will be operating income and minus interest for taxes, interest and taxes which you have paid. So, operating income we have calculated. So, net income for company 1 for year 1 will be this is 2150 minus tax is 3,400 and interest is 766. So, 766 plus 3,400. So, if you subtract that, it will be 15,984. Similarly, if you have to calculate the net income in for year 2. So, year 2 net income is operating income is 21,960 and minus you will subtract these interest is 870 and taxes are 3,490. So, it will be 870 plus 3,490. So, if you subtract that, it will be 17,600 rupees. So, you got the net income as 15,984 and 17,600. So, EPS you will get. So, EPS for year 1 will be net income divided by number of shares. So, net income 1 by number of shares 30,000, that is 15,984 divided by 30,000. So, it will be 0.53 roughly, and if you calculate EPS 2, so it will be 17,600 divided by 30,000. So, so that came equal to, if you do it, it will be something close to 59. It will be 583 or 3 or so, 586 or 5867 something like. So, 59 we can take. Now, once we have EPS 1 and EPS 2 and we have operating income in year 1 and year 2, then we can find certainly the DFL, and we have a basically matrix. We have a matrix formed now. We have operating income 1, operating income 2, and so we know that this is your EPS. If you look at, so you got 21. So, you had the operating income as 2150 and year 2 was 21,960 and EPS is 0.53 and you have 0.59. So, this is your EPS 1 and this is your EPS 2. So, now if you have to calculate the degree of financial leverage, it will be this minus this divided by EPS 1 minus EPS 2 and 2 minus 1 divided by EPS 1, then whole divided by OY 2 minus OY 1 divided by OY 1. So, you can finally find DFL as EPS 2 minus EPS 1 divided by EPS 1 whole divided by OY 2 minus OY 1 divided by OY 1. So, this is how you will get EPS 2. We know that it is 0.59, EPS 1 is 0.53 divided by 0.53, and then further OY 2 is 21,960 and then this is 150 divided by 2150. So, if you look at this ratio, it is coming as 1.26. It means that if there is a change of the operating income by 1%, in that case the change in the earning per share will be 1.26%. So, that is what the meaning of the degree of financial leverage will be. Now, this is the calculation of DFL when you do not have the data of the dividends which are to be paid to the preferred stock. Now, let us say if the condition is that the company has preferred stock also, company has distributed. So, if the company has distributed 43% of its net income, so 43% of its net income. So, that it has distributed as dividends for preferred stocks. Now, what will happen in that case? So, how DFL is affected? So, in that case what you have to do is you have to find further the EPS 1 and EPS 2. So, the dividend which is paid will be 43% of the net income. So, preferred stock dividend will be 43% of net income. So, net income we have already calculated, and so that is why for year 1. So, for year 1 it will be for 43% of 15,984. So, that will be 6873, and similarly for year 2 it will be 43% of 17,600. So, it will be 7568. Now, once you calculate the EPS in that, basically what we find is in the EPS, in the net income you are paying the amount the dividend of the preferred stock from the net income. So, if you calculate the EPS for year 1 and 2, it will be different. So, EPS 1 now in this case will be basically whatever net income you have to subtract this. So, suppose 15,984 minus 6873, and that is divided by 30,000. So, this will be coming as 0.3037. Similarly, if you find the EPS in the second year, now again here also the 17,600 minus the 43% that is 7568 divided by 30,000, and that will be coming as 0.3344. So, once you get that, then you have to calculate the DFL, and if you calculate the DFL, so DFL in that case you have these different values, and if you calculate the DFL in that case, so DFL if you calculate, so it will be EPS 2, so it will be 0.3344 minus 0.3037 and divided by 0.3037, and then this is divided by your same thing, that is your 21,960 minus 2150 and divided by 2150. So, this way if you calculate the DFL, it will be coming out as 1.125. So, what you see that the DFL was earlier 1.26, and since you have paid the dividend to the preferred stockholders, so your DFL has gone down to 1.125. in this case, it means your if your operating income is changed by 1%, your EPS will be changed by 1.125%. So, that is what the meaning is, and we calculate the DFL in such fashion. Now, we will talk about the combined leverage or total leverage. Now, when you have the both operating leverage and combined leverage, they have so both have the strong effect on the firm's earning per share, and that is what the combined effect of both the types of leverage is known as the total leverage. And in this case, it is the nothing as it is defined as the potential use of both operating and financial fixed costs to magnify the effect of changes in sales on firm's earning per share. So, in that case what we do that you have to have the combination of these two, and that is why your change in sales income and how it affects on earning per share, that will be known as your the total leverage. So, degree of combined leverage can be combined as product of degree of operating leverage DOL multiplied by degree of financial leverage. So, there will be a link between the two and how that will be changing. So, basically what is the formula is that degree of combined leverage DCL, degree of combined leverage, and it will be degree of operating leverage multiplied by degree of financial leverage. So, this is how the degree of combined leverage will be changing. You see that DOL, when we define DOL, it is nothing but percentage of operating income, and with respect to the percentage change in sales, and then this is percentage of the earning per share with respect to percentage of operating income. So, what you do is see that this both will be cancelling, and it will be giving you the change in earning per share with respect to change in the sales. So, what we see that it will be percentage of change in earning per share to percentage of change in sales. So, this is how we calculate, and we can write EPS 2 minus EPS 1 and then divided by EPS 1, and then further you have S 2 minus S 1 and divided by S 1. So, this way we calculate the degree of combined leverage, and you can further simplify EPS 2 minus EPS 1 divided by EPS 1 into S 2 minus S 1, and here it will be S 1. So, this way you can calculate the degree of combined leverage, and you may have the data, you can have the data where the values are given, and you can directly use those formula to find these degree of combined leverages. You must be also knowing certain other formulas for finding the degree of financial leverage, and degree of financial leverage alternatively you can use certain formulas. So, when you have at a base of the operating income, so you can have this OY divided by OY minus 1 plus DPS divided by 1 minus T. So, this is I, and this is how you calculate the directly the degree of financial leverage. So, here OY we know that it is the operating income, and I is the interest, and DPS. So, when you have the preferred stocks, so if you have the problems where it deals with the preferred stock dividends, so that can be directly used. So, DPS will be dividends for the preferred stock, and T is the tax rate. So, many a times tax rate is also supplied. So, in that case income taxes, in normal situations you calculate the income tax, but tax rate may be there. So, certain percentage of may be given. So, that percentage is there. So, in that case 1 minus that percentage will be there. So, that can be used, and directly you can get the DFL. Similarly, you can also find the degree of combined leverage also by using some formula directly, and that formula becomes like Q into P minus V, and divided by you have Q into P minus V, then you have minus FC minus I minus, then you have DPS and by 1 minus T. So, this way you do you can calculate the degree of combined leverage, where Q is the given size of production, and you have P and V, you know that P is the price of unit of production, and V is variable cost per unit. FC is very clear, it is fixed cost. So, FC will be fixed cost, and then I is the interest rate, and DPS is the same thing, like dividend for the preferred stock. So, that way these formulas can directly be used for the calculation of the DFL or DCL, not DCS, this is DCL, degree of combined leverage or total leverage. So, this is basically about the chapter on leverage, and you can keep these formulas into your mind, and that can be used for solving these problems. Thank you very much.